What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button and join me on my journey, and also to hit the like button to help out the YouTube algorithm. In today's video, I have episode 18 of my dividend investing journey, and since the last time I updated you guys, I have added another £500 capital and made one new investment. That investment being in Coca-Cola, in which I have purchased 13 shares for an average price per share of £38.59. I will now give you a rundown of who Coca-Cola are and what they offer, and then we'll jump into the financial reasons as to why I purchased Coca-Cola. So, as many of you will know, the Coca-Cola company markets, manufactures and sells beverage concentrates and syrups, and also finished beverages including sparkling soft drinks, water, sports drinks, juice, dairy and plant-based drinks, and tea and coffee. Looking at the beverage side of their company, Coca-Cola produces not only their infamous Coca-Cola, but also brands such as Fanta, Sprite, Powerade, Innocent and Costa Coffee, which it acquired last year for an eye-watering £3.9 billion. So having a look at Coca-Cola from a financial standpoint, starting with their share price and how it has changed over the past few months. Until February, when the market saw a crash, Coca-Cola had been on a bull run and was at its all-time high of $60.13. At the time of making this video, Coca-Cola's share price is around $47, which is a decline of around 28% from its all-time high. This is a huge shift in price for a company of Coca-Cola's magnitudes, and now it presents itself at a very attractive entry point. Next, if we look at Coca-Cola's return to shareholders over the past 5 years, we can see that it has returned 35.4% if we include dividends. Now, this might be lower than that of its industry, which stands at 42.8%, and the market as a whole of 48.4%. However, we must take into account that we're investing in a huge global company with unprecedented brand recognition, and also with this comes a huge safety moat. In my opinion, sacrificing some returns for the safety and stability is a no-brainer. With this said, Simply Wall Street currently undervalue Coca-Cola by 13% in comparison to its fair value, meaning there's a discount to be had right now. Coca-Cola has a future return on equity of 50.7%, which shows that management are using the shareholders' cash efficiently to generate profits for its shareholders. If we look at Coca-Cola's past earnings analysis, we can see that over the past 5 years, its earnings have declined by 0.2%. However, this is trumped by its growth over the past year of 48.6%, which also bettered that of its industry of 7.3%. If we combine this with Coca-Cola having high quality earnings and its profit margins being 26.9%, which is higher than that of last year's of 19.4%. Coca-Cola's return on assets are greater than that of the industry it finds itself in, and also its return on capital employed is greater than that of 3 years ago. Looking at the financial health of Coca-Cola, we can see that its short-term liabilities and long-term liabilities are not covered. However, I'm not too concerned as Coca-Cola's long-term assets are greater than that of its liabilities and could bail itself out if the worst was to happen, which for a company of Coca-Cola's size is unlikely. Moving on to Coca-Cola's dividend, it currently has a yield of 3.51%, with its ex-dividend date coming up on the 12th of June, which still gives you time to pick up Coca-Cola now and claim its dividend, which is to be paid on the 1st of July. Touching more on Coca-Cola's dividend, it has not only maintained it, but also increased its dividend for the past 56 years, which is fantastic for my portfolio's compounding power in the future. Finally, to wrap the analysis off, we can see that Coca-Cola's dividend is well covered by the payout ratio of 69%, and in the future, this is set to increase to 77%. So guys, before we jump into the live segment of this video, I first want to talk about some of the major movers in my portfolio this week, and the two in question being Uber and Virgin Money. Starting with Uber, which has been really volatile this past week. Looking at its share price, on the 29th of April, we can see that it was trading at $31.37. This saw a big pullback, which on the 5th of May, it was trading at $27.42. And finally, at the time of making this video, it is trading at around $31. So looking at some articles to try and explain these sudden price changes. Starting with an article from Forbes, it states that Uber is planning on ending operation in 8 markets, of which these are the Czech Republic, Honduras, Egypt, Romania, Ukraine, Saudi Arabia and Uruguay, and is also transferring Eats to its subsidiary Careem platform in the United Arab Emirates. My take on this is a positive one from an investor's point of view. As the article states, these decisions were made as part of Uber's ongoing strategy to be in the first or second position in all its markets by leading into investment in some countries while exiting others. To me, this is a positive move and shows they're focusing their time and assets that are seeing better returns and getting out of those that are lagging, which is smart business in my opinion. The second article I have is from MarketWatch, which states Uber lost $3 billion in 3 months, which is rather concerning from an investor's point of view. Uber reported a first quarter loss of $2.9 billion or $1.70 a share, compared with $1.01 billion in the year ago period. Revenue swelled 14%, however, to $3.54 billion, up from $3.1 billion in the year ago period. The company took a $2.1 billion impairment write-down, which it said was primarily related to our investment in DiDi, as the credit loss allowance recorded on our investment in Grab. Uber exited its operations in parts of Asia in exchange for stakes in those 2 Asian ride-hailing companies. The article then goes on to say the industry-wide slump could accelerate in the second quarter. Wedbush securities analyst Dan Ives warned in an April 29th note, with Uber particularly vulnerable because of its exposure in Europe and Asia. He anticipated a 41% dive in revenue year over year in Uber's first quarter. My take on this again is a concerned one, as if these sort of figures materialise, then Uber's share price is going to be majorly affected. But again, I believe long term in Uber, and if it hits its share price, I will definitely buy again. Now moving on to Virgin Money, we can see that an article from This Is Money states that Virgin Money's profits dropped 60% in its first half. It also goes on to state that the groups admitted that around 12,000 of its credit card customers, or 1.2%, were already seriously in arrears by 3 months or more before the pandemic, but claimed this was well below industry norms. The article also states Virgin Money is under mounting pressure this week after it was revealed that over 30,000 of its credit card customers have had their cards temporarily blocked by the lender. And the bank posted underlying pre-tax profits of $120 million for the 6 months to March 31st, down 58% on the $286 million reported at the same point a year ago. Finally, its charges for the first half included an extra $164 million set aside for the pandemic-related impairments amid predictions that the number of people who will not be able to pay back their bank loans back will surge over the next few months. Now, my summary of this is a dire one. This shows that Virgin Money's profits have not only been hit, but will continue to be hit whilst the pandemic continues. For me, this is very concerning, as this is the stock I have invested the most amount of capital into, and is also the stock I am the most down on. Moving forward from this, I believe that I have learned a lesson as to not be so aggressive averaging down in a falling market, but also not to overexpose myself to a single sector. I will eventually buy more Virgin Money, however, not until the future is that of a brighter one and when the economy picks up. Welcome, guys and girls, to the live segment of the video in which I'll be updating you on the portfolio and how the individual shareholdings have performed over the past week. To give you some sort of reference, the S&P is up 3.53% and the FTSE is up 3.15%. So let's see how the individual shareholdings have performed in relation to the market, starting with the investment ISA. MasterCard, we are up 12.38% with a gain of £74.02, and over the week it has risen 3.62%. Uber, we are up 6.57% with a gain of £32.25, and over the week it has risen nicely 8.95%. Pfizer, we are up 2.52% with a gain of £12.42. However, over the week it has fallen 1.81%. Coca-Cola, my new purchase, we're not doing too great. We are down 7.11% with a loss of £35.66. And over the week it has fallen 2.19%. Now moving along to the basic account. Starting with HSBC, we are down 19.97% with a loss of £259.66, and over the week it has risen 2.55%. Virgin Money, we are down 35.45% with a loss of £354.71, and over the week it has risen 2.17%. AT&T, we are down 14.42% with a loss of £97.77, and over the week it has fallen 3.38%. Legal and General, we are down 26.27% with a loss of £183.83, and over the week it has risen 4.62%. 3M, we are down 4.25% with a loss of £20.80, and over the week it has fallen 1.92%. Unilever, we are down 5.62% with a loss of £26.73, and over the week it has fallen 0.39%. Aviva, we are down 31.68% with a loss of £195.78. Over the week, however, it has risen 4.13%. And finally, Johnson & Johnson, we are up 7.15% with a gain of £15.84. And over the week, it has fallen 0.47%. So that wraps up my portfolio update for this week. I'd like to report that I have received a dividend payment from AT&T for £8.87, which was nice as I haven't received a dividend payment for a while now. The portfolio is currently sitting 13.87% down, or 12.62% if we account for the dividend income and currency gain. All in all, this has been a decent week for the portfolio, with some very nice upside returns from a few of my holdings, which is clawing back some of the losses, and the portfolio has risen in comparison to last week, where we were down over 14%. So thanks for watching. If you've liked the video, please drop it a like, subscribe if you want to see more content like this, and if you've missed any previous updates, there will be a link to the playlist in the description below. Until next time, peace.